the meeting to order, the SDCERS Board of Administration for January 8th. And I'd like to ask Ms. Joyner to call the roll and determine if we have a quorum.
Okay, Ms. Bride,
Here.
Ms. Coleman,
Here.
Mr. Battaglia,
Here.
Mr. Hallquist,
Present.
Mr. Kenny,
Yes.
Mr. Maggi,
Here.
Mr. McBride,
Oh, hey, thanks a lot.
That'd be great.
Mr. McBride. I'll come back to you, Mr. Provost. Okay.
I'm here.
All right, Mr. Provost,
It bells on.
Ms. Spoon,
Here.
Mrs. Shearson,
Yes, good morning.
Mr. Kaufman.
Yes, here.
Everybody's here today except Jeffrey Wallace, who's out,
Okay, great. Thanks so much.
and we have a quorum.
Okay, just as a reminder, today, since we're on video again, if you're making a motion or a second, please say your name before you make your motion or together with your motion so that Ms. Joyner can keep the records accurately. And do we have any public comment, Ms. Joyner?
No public comment.
Okay, thank you. So next we're moving to consent agenda. We are going to vote on A, B, and C all together and then come back to D separately as there was a recent change. Sabrina added some educational materials. So can I have a motion and a second for consent agenda A through C?
So moved, Karina Coleman.
George Kenny, second.
Okay, we
ready to
are
vote?
ready to vote. Ms. Bride,
Yes.
Ms. Coleman,
Yes.
Mr. Battaglia,
Yes.
Mr. Hallquist,
Aye.
Mr. Kenny,
Yes.
Mr. Maggi,
Yes.
Mr. McBride,
Yes.
Mr. Provost, Mr. Provost. I'll come back to.
Yes.
Okay.
Yes. Yes. Yes.
Ms. Spoon,
Yes.
Mr. Shearson,
Yes.
Mr. Kaufman.
Yes.
All votes are in, and the motion passes 11-0.
Thank you. So next, we will vote on item D, training and training requested educational conferences, and let's have a motion in a second.
You know what? I can't present.
Sorry, Carol, if I could jump in, can we add the additional conferences to the discussion?
Oh, wait, never mind. Sorry. Got it. I can't really see it, but.
Is this going to work for you, Greg?
Yeah, if I could say a couple things before we vote.
Oh, sure. Go ahead.
Oh, thank you. Before the board at this moment, we have a recommendation to approve the requested educational conferences as noted in our board materials. And as you know, board members are encouraged to attend educational conferences to stay abreast of best practices in public pension plan governance, operations oversight, and institutional investment. And I am pleased that Karina Coleman would like to add her requested educational conferences to the list that's being voted on. And specifically, she would like to go to the Institutional Investors Risk and Liquidity Forum, which is a virtual conference this coming later this month in January, the Global Interdependent Centers Long-Term Effects of Racism virtual conference in February, the SACERS Public Pension Investment Management virtual conference coming in July, and the Fox Marks Group Women's Private Equity Summit in a location and time to be determined later in the year. Thank you.
Thank you. That's very helpful. And now let's have a motion and a second.
I'll make a motion to put this on the table.
And
Paul?
Paul?
that was Paul. Okay, Paul.
This is Charlie. I'll second.
Thanks, Charlie. Okay, we are ready to vote. Ms. Bride,
Yes.
Mr. Battaglia,
Yes.
Mr. Hallquist,
Aye.
Mr. Kenny,
Yes.
Ms. Coleman,
Yes.
Mr. Maji,
Yes.
Mr. McBride,
Yes.
Mr. Provost,
Yes.
Ms. Spoon,
Yes.
Mr. Shearson,
Yes.
Mr. Kaufman.
Yes.
All votes are in, and the motion passes 11-0.
Okay, thank you. Next, we're heading into business operations. We have an important presentation today. It's not an action item. It's our first draft, really, or first look at the annual valuation for the fiscal year ending June 30th, 2020. And as you know, we review this every year in January, and then we look at it again for final approval in March. And of course, this determines our ADC for our plan sponsors July 1st. And so today we welcome Gene Kowarski and Alice Alsberg from Chiron.
Good morning, everyone.
Morning, Gene.
Good morning.
Good morning. Hopefully next year we can present it in person. So, who's driving Cynthia, are you driving the PowerPoint?
Jessica is.
Jessica, okay, so go on to the next slide. So we'll provide some background information, and as usual, we'll go over the historical trends and then dive into the June 30th, 2020 valuation results, and we conclude with a look ahead. Also, in the appendix, you'll see revised member contribution rates resulting from the experience study changes. Next slide. As Carol mentioned, this evaluation is being used to determine the fiscal year 2022 contribution rate for the plan sponsors. And for the city, they typically make that payment right on July 1st, 2021, which is the beginning of the fiscal year. And again, repeating Carol, we'll be coming back in March in the event that the board has questions or raises questions on this valuation that may cause modifications, although I don't think that'll happen. Next slide. This slide shows all the different plans. In total, there's 16 different city plans. When you look at the general, elected, fire, lifeguard, and police in the different tiers, and 6 for the Unified Port District and 2 for the Airport Authority. So there's over 22 different benefit plans in SDCERS. So before we get into the valuation results, Alice, why don't you talk about the experience study summary of those changes?
Great. Thank you. So slide 4, please. So I would say that the highlight of this year's actuarial valuation was incorporating the changes of the recent experience study that we completed. So the last time that Jean and I were before you was during the July meeting when we presented the results of the actuarial experience study. And the experience study focused on economic and demographic assumptions, but the only assumptions that were changed based on that study, based on the analysis, were the demographic assumptions. Now, the demographic assumptions focus on turnover of participants. So we look at, just to recall, we look at mortality, retirement, termination, disability. We look at merit and several other assumptions, analyze those, and the results of that experience study went into this valuation. So this valuation is the first to see the impact of the experience study changes in the liabilities. And the most meaningful assumption change was to the mortality assumption. And that mortality assumption, when we get into the details, the numbers of the impact, you'll see the actual impact on the UAL and the ADC from the assumption changes, but it was the mortality that caused the most significant increase. And something to note here that we discussed that's pretty actuarial in terms of the details of it, But a mortality assumption is also coupled with a mortality improvement projection. So for valuation purposes, that improvement projection uses the fully generational improvement, but for contribution rates, for annuity factors, for purchase service rates, to use a fully generational mortality improvement projection is quite complex. And so an actuarial equivalent process is done to use what's called a static mortality improvement. And so those static improvements were used to approximate the impact of a fully generational mortality improvement. And the reason why I get into that is because the member contribution rates, so the rates for the members, which for the city, they're recalculated every time that there are new assumptions to maintain this substantially equal requirement by the city charter. And the impact of the assumption changes, so all the demographic assumption changes that are in this new valuation, in aggregate, will increase general member rates by 1.4% of pay, police safety member rates by 2% of pay, and then the non-police safety members in aggregate average 1.6% of pay. Slide 5. The port and the airport had very similar experience in terms of the demographic assumption changes, slightly different when it comes to retirement, termination, their merit increases were different, but the mortality is studied as a whole for the whole SDCERS system. So both the port and the airport have similar impacts to their UAL and ADC from the demographic assumption changes, namely that mortality assumption. And within the port, 2 of the tiers, the PEPRA tiers, so the miscellaneous members under PEPRA and the safety members under PEPRA, and for the airports, the members who are under PEPRA, their contribution rates are also recalculated whenever there is a change to the aggregate normal cost of greater than 1%. So in this case, based on the results of the experience study, we concluded that it was necessary to recalculate the rates for the PEPRA tiers as well. So for the safety members in aggregate, it amounts to a 1.2% of pay. The port miscellaneous members were unique because at the time of original calculation, it was based on an assumed population. So the net effect, some rates went up, some went down. And for the airport members, that aggregate increase amounts to 0.5% of pay. Next slide, please.
Okay.
The next Jean.
All right, and next slide. You know, someone was bringing up an old song prior to this meeting starting. I'll bring up the song. You may have heard, "Every Picture Tells a Story." Well, this is "Every Picture Tells Lots of Stories," and this one does. This is historically showing the system's assets and liabilities. The bars are the liabilities, the assets are the line. There's a smooth asset and market value lines. Then you see the funded ratios at the top. You can see from 1995 through 2000, the system was well over 90% funded, nearly fully funded. Then the dot-com bust happened in conjunction with the infamous MP1, MP2 arrangements, where the system's funded ratio bottomed out at 65.8 in 2004. Then the system made some rapid improvements, almost to 80% by 2007, and then the Great Recession hit. And the system dropped down as low as 66.5 in 2009. The system has made steady progress since then, although it's slowed, but that sort of masks what's really been happening, because in the early part of this chart, the system's discount rate was 8%, and today it's 6.5%. So the fact that the system's funded ratios gradually improved at the same time lowering the discount rate is a very positive thing, and we'll talk about that more later when we compare SDCERS to other plans. Next slide. This slide compares what the actuary determines in each valuation by the blue bars versus what the city actually contributes. And you see in 2003, 4, and 5, there was some chronic underfunding by the city. And then starting in 2006, the city either made the full ADC or exceeded it. Between 2006 and 10, there were some legal settlements, including a tobacco settlement that resulted in the city paying more than what the actuary determined. And then from 2011 on through fiscal year 21, the city paid exactly what the ADC was. And the last bar is the payment that the city would be making on July 1st this year. Next slide shows a history of gains and losses. The gold bars are gains, the gold bars are investments, the blue bars are liabilities. Gains are above the zero line and losses are below the zero line. You can see there's a lot more volatility and size to the investment gains and losses compared to the liability gains and losses, which are much smaller. But there was a somewhat troubling pattern of liability losses from 2012 through 2020, and that's why the experience study had the changes it did for mortality and some merit increases. The next slide, I think, George, I give you credit for creating this slide. You keep asking why has the unfunded liability increased so much since 2007. It's increased by more than $2 billion. And this slide is showing what caused it to increase in each of the years, but I'm going to focus solely on the bar to the far right, which adds up all the years combined. So 2.15 billion was the increase since 2007, and if you add the black bar and the gray bar, which are assumption changes, economic and demographic, in total, they add up to nearly 1.7 billion. So the vast majority of the increase was assumption changes. We also had 439 of liability losses and 689 of investment losses over this 13-year period. And then contributions and PSC corrections resulted in lowering the UAL.
So can I ask a question, Gene?
Yes.
So in 2016 was the last time we did the experience study that resulted in a big impact from mortality, right?
Yes.
And I remember at the time, maybe my memory's poor, but getting the impression that it was a very complete, thorough, impactful event, and that we wouldn't see another impact like that, for the foreseeable future. Were you surprised at all by what's happening this year in that figure? And is there some way that we can understand that, or is there a different methodology, or? Yeah.
Well, the Society of Actuaries has been doing exhaustive studies on mortality for the past 5, 6, or 7 years. And each time they come up with a new study, they're finding improvements on mortality are continuing. And I think we've shown a chart, I don't have it at my fingertips here, and even if I did, I couldn't show it, showing that it isn't so much that people are living longer at the end of life, just more and more people are making it their way to their 80s and 90s than ever before. And at this stage, we looked at during the experience study of what happened with mortality, and while we anticipated what happened in 2016 to take care of it, it didn't take care of what Alice referred to earlier as generational improvements, that each generation is living longer. So now what we have built into this year's liability is not only what's happened since the past experience study, but we're building in generational improvement for the future.
Oh, I see. Okay.
Which we didn't do in 16.
Okay.
Yeah, we had a partial improvement in 16, but not the fully generational. So.
Mm-hmm. Okay, thank you.
So, Alice, why don't you take over on the historical results for the other plan sponsors?
Great. Slide 11, please. So the Unified Port District has a similar pattern of funded ratio as the city does in the second half of the year shown here. In the initial years, the port was very well funded, over 100%. And similar to the city, it was that 2008-2009 economic crisis that dropped the funded ratio. to 75.3% at its lowest. And it slowly increased over that period of time. But mind you, in 2009, like Jean mentioned, the discount rate was at 7.75, whereas today in 2020, it's at 6.5%. So although the funded ratio has maintained in that 75 percentile, it's still improving given the fact that it's under a lower discount rate. Slide 12, we see the historical pattern of contributions paid by the port compared to the ADC, the actuarially determined contribution, and the port consistently pays the ADC as calculated to fund the plan. And in 2022, that ADC stands at $22.1 million. On slide 13, we show the pattern of investment gains and losses and liability gains and losses. Again, those investment gains and losses really provide a more significant impact in terms of volatility, whereas the liability tends to fluctuate slightly up or down gains or losses depending on the experience for the year. So the port this year, you'll see that the dark blue liability experience, the port experienced a gain this year in terms of liability, a 0.4% gain on their liabilities. Next slide. Here we show the buildup of the UAL changes over time, and the net increase on the UAL for the port is 111 million, and really the most substantial, 145 million. And the most substantial increases are the 44 million that you see in that purplish gray and the 67 million in black. Those are from the demographic and economic experience changes, assumption changes over time. So those assumption changes amount to the greatest portion of the increase in the UAL for the port over time. And in 2020, we see that the largest change there was from the demographic assumptions, and we'll get into the figures in a later slide. On slide 15, we get into the results for the airport authority and take a look at the historical experience for the airport. What is always refreshing to see at the airport is this funded ratio, for example, in 2020, sitting at 89.6%. In 2019 in the 90s. So the port has its own funding policy where they maintain a threshold of a minimum of 90% funded by making additional contributions each year. And then once they reach that 90% funded, then they have a policy which takes them up to 95% funded and making additional contributions until they reach their threshold. So we see on slide 16, with the airport's contribution history, the gold bars, the actual contributions paid by the airport, historically are above the ADC, the actuarially determined contribution, and those are the excess contributions that the airport makes to catch up and maintain the funded ratio that's determined, that's driven from their policy of the 90% and higher. On slide 17, we see the historic investment and liability experience. Again, the investment experience is much more volatile than the liability experience. The airport, though, we see that the liability experience is a little bit more prominent than what we saw for the city and the port, and it's because it's a smaller plan. So those fluctuations tend to be relative to the size of the plan. And in 2020, the airport experienced a liability gain of 0.8%. And I'll get into the details of that in a later slide here. On slide 18, we show the factors that led to the current UAL of the airport today. Again, in the most right column, the 19 million plus the 18 million, Those are the two components from the demographic and economic assumption changes, which amount to a $37 million increase on the UAL. But the airport has a more offsetting element on the UAL, and we see in gold there the negative $12 million. So those excess contributions have served to bring down the UAL over time as well. And with that, I'll turn it over to Jean to get into the results of the current valuation.
Alice, I have a question there just on the term, on the timing of the contributions. Do they vary across the different plans? It looks like the port contribution for 2021 was already paid. Can you maybe just distinguish if some are paying at the start of the year versus the end of the year?
Let's see. So on this similar...
two slides before this, I think.
Let's see. Can we move to slide 16?
Yeah.
Is this what you're referring to, Karina?
Yes.
Okay, so here for fiscal year 2021, we see that contribution is recorded there because it's paid for fiscal year 2021. It was paid on 7/1/2020. So as of today's date, we know that that payment was made, and that is similar for
the city, right?
Similar for the other two plan sponsors. The only component that we don't show here for fiscal year 2021 is that excess contribution that you're asking about for the airport, because they pay that excess contribution towards the end of the year. I believe last year it occurred in the in the second quarter of the year, just before the end of the fiscal year.
Thank you.
So now you could flip all the way to slide 20, which are the valuation results for the city. The key results in the dark blue area are the valuation results for the membership. And in the gray area, assets and liabilities, and in the gold section at the bottom, contributions. You can see actives in the city plan declined as expected, given the largest part of the plan is closed for now. Payroll, though, is increasing still, and a key figure on this page is the average salary. Average salary increased by 7.5%, which is well above our assumption. And that's, you'll see later on, has contributed to the increase in the ADC. The average benefit and pay status only increased by 1.9%. Then in the gray section, liabilities grew by 5.7%, which is greater than both the actuarial value of assets and the market value of assets growth. In fact, the market value declined. The unfunded actuarial liability, which is measured on the smooth basis, increased by 10.9%. And that resulted in the funding ratio declining from 71.6 to 70.2. And on a market value basis, it would have been 68.3. That all those liability and asset impacts lead to a ADC in the gold section increasing from 365.6 to 414.9, and we explain the sources of these changes on the next slide. So the next slide explains the sources of changes in liabilities, assets, the unfunded, and the ADC. I'm just going to focus on the last two columns because the UAL column is simply the subtraction of assets from liabilities. So the unfunded liabilities started at $3.007 billion and ended at $3.3357 billion. We would have expected, if all assumptions were met and no experienced gains or losses and no assumption changes, that the unfunded liability would have declined by 152, but the asset experience actually increased the unfunded by 122.5. And the liability experience, largely driven by pay, that 7.5% average pay increase, increased the UAL by $66.9 million. And then the demographic changes, primarily mortality, increased the UAL by 291.1. And that 291.1 is about 2.7% of total liabilities. So that directly contributed to the ADC increasing from 365 to 414. You can see the demographic assumptions were the largest part, 30.9. and the asset experience was 12.3.
And Jean, the amortization term for the demographics is 20 years, right?
Yes,
Okay.
that was something the board changed a few years ago. So, we performed some projections for the city several months ago, beginning of the year, at the request of the city, and this 414.9 actually came in, I think, a few million less than what we anticipated from our study for the city early in the year. So, Greg, I don't know if you want to elaborate. I mean, the city was well aware of this number coming in. All right.
All I'll say is, yes, they were.
Okay. Alice, why don't you take me through the port and the airport? Slide 22.
This is George Kenny. Before you do that, I just note, with a little bit of concern that we're down to around 70% unfunded liability. And I know that the increase is, often beyond our control because of the change in demographics. That was the big part. But my question is, I have two questions. One, what are we as a board, what would be prudent action for us to take? I don't know, but I think it might be a good discussion. And the second is to Greg, with the new administration, what is their understanding of this the meaning of a 70% unfunded, 30% unfunded liability, and what is their concern or awareness about the increase that the city is going to have to pay in July?
So I will tackle those questions. Good questions. Thank you, George. As Jean had previously mentioned, the staff in conjunction with Chiron had been assisting the city with a 5-year projection of anticipated ADC costs. And using the 2019 valuation as a basis, we did a 5-year projection. So the city does perform a 5-year projection each year. So they are well aware of their current funding status and the potential for the ADC payments moving forward, assuming all of our current assumptions are being met. With regards to being concerned about the funding status, that is a concern. And as Jean has pointed out, a lot of it is what is the story and why is your status where it is. And I think the SDCERS plan has actually a very good funding story, and that one of the reasons we have a funding status of around 70% is because we've been adding more conservatism into our long-term projections. If you take a look at many of the pension plans across the United States, we are about average in our funding status, but they have a different story than us. Many of them actually have funding models that are less conservative. So I believe we have a solid long-term funding plan, and we should stay with a solid long-term funding plan and move forward with it.
Thank you. I agree we have a great story. My question is, that's a pretty big increase in July, and I'm sure revenues in the city have not been great. I don't know. How would you assess the risk of that payment, Greg? Yeah.
The one thing I will mention is that we, are aware that in our funding objectives, sustainability, plan stability are part of that, and we want to make sure that our plan sponsors are adequately funding the plan for the long term, and that they have the ability to make the contribution payments. At this point, these funding costs, while not, favorable for increasing into the city's budget, they are planning on making their full ADC payments at this time, and they recognize that of their duty and obligation to properly fund the plan.
Thank you.
Yeah, thank you, Greg. That was a very helpful discussion and explanation. And we will be looking at some charts later, I think, that show our funding status relative to other plans, adjusted for the difference in the discount rate and showing us to be in reasonably good competitive shape on a funding basis.
And Carol, I'd like to add one thing to this as well. So we have Mayor Todd Gloria and Chief Operating Officer Jay Goldstone, who are the new administration at the city. Both of them are very well versed in the pension plan. When they were in the city government before, we met with both of them on a regular basis. This would have been back when Mark Hovey was here. They left before Greg came on board, but they definitely are very familiar with how the pension plan works and all the things that we do here. So that's, I think, a positive for us, that we have a new administration that's come in that is very well versed in what we do and how we are funded. I think that will be helpful as we go forward.
Mm-hmm. Yep. And I could add, Marcel, that in our presentation to the City Council, Mr. Todd Gloria was one of the most astute council members when it came to pension matters. And when it came to Jay Goldstone, he likewise was really sharp when it came to the pension plan. So I didn't know Jay came back, and it's good news.
He is back as the interim COO as they continue a nationwide search for a permanent chief operating officer. So yes, Jay is back.
Thank you, Marcel.
And so with city results being presented, can we go to slide 22, and Alice will take you through the evaluation results for the other plan sponsors?
All right, thank you. So here we see in the top portion of this table the membership experience. So active members stayed steady. That average salary for the port only increased by 1.1%, which is less than expected. And we'll see how that translates to a liability experience gain on the next slide. In terms of the actuarial liability increased by 5.9%, whereas the actuarial value of assets increased by 4.3%. And since the liabilities increased at a greater rate than the rate of assets, that means that the actuarial funded ratio coming in at 74.5% is down from the prior year of 75.6%. In the bottom of the graph in the yellow section, when we see the breakdown of the ADC, the employer normal cost increased to $5.8 million, up from $5.2 million. The UAL payment coming in at 15.6, and the total ADC for the fiscal year 2022 at $22.1 million, which is up from the prior year of $19.7 million. On the next slide, focusing again on the second two columns, the UAL and the ADC, we see how the UAL changed from 2019 to 2020 and how the ADC changed from last year to this year's ADC for the plan. So again, the assets experienced an asset loss. So the UAL increased by $7.6 million, which translated to an increase on the ADC of $0.7 million. Liability experience was favorable for the poor, and that was largely driven by those salary increases being less than expected, which decreased the UAL by $2.4 million and decreased the ADC by $0.2 million. The demographic assumption changes, which we spoke about extensively, increased the UAL by $18.8 million and the ADC by $1.8 million. So as it stands for fiscal year 2022, the ADC for the poor is $22.1 million. On the next slide, we get into the similar summary of the valuation results for the airport. So the airport had a steady increase in the active population. The average salary we see had 0.0% change, so a slight tick down if you look at the numbers. So the airport, on average, the salaries did not increase as expected, so they also had a liability experience gain in this year's valuation. In the middle gray section there, when we look at the actuarial liability increased by 9.2%. The actuarial value of assets increased by 7.8%. So those two elements together led to a decrease in the funded ratio from 90.8% last year to 89.6% this year. The ADC for the airport last year was $6.1 million, and this year at $6.57 million. And the components of change also resulting from increase on the UAL payment from the assumption changes. On the next slide, we see how the UAL and the ADC changed. Again, there's the asset experience, increase the UAL, increase the ADC. The liability experience was favorable for the airport in that the salary increases, the majority of it was the salary increase were less than expected, decreasing the UAL by the 1.976 million and the ADC by 0.56 million. The demographic assumption changes increased the UAL and the ADC, bringing the total UAL up to 24.8 million and the ADC for fiscal year 2022 to 6.6 million. Any questions on the results for the port or the airport?
So we conclude our presentation with what Carol alluded to, comparing you to your peers, and we're going to be, and you can go to the next slide. There will be two different types of comparisons. One to the public plan database, which is data collected by NASRA and in conjunction with Boston College's Center of Retirement Research, annually puts together data on what's now about 188 of the largest plans, public plans in the country. And we teamed up with both organizations to create a tool that people can access on our website, so you can compare not only your plan, but any plan in the country to the universe, with metrics that appear at the bottom of the slide, assumptions, funding ratio, maturity ratios, and tread water and the like. But we're just going to show a select few here today on how SDCERS compares to this database, and then Alice will then show how SDCERS compares to your peers in California. So the next slide is a very good story for SDCERS. The black dot is SDCERS, and the various colored ratios are the different percentiles. The light blue would be the 75th and 95th percentile, and then at the bottom of the blue, that's roughly the 50th percentile. And you can see SDCERS back in 2001 was right in the middle of the pack, but then you've been dropping your discount rate, and so have others, but not as rapidly as SDCERS. And now you're even outside the fifth percentile. You're at the 1 percentile with the lowest discount rate. And I think that's something to be, that's something very positive. The next chart is showing the net cash flow of the city compared to other plans. Net cash flow means contributions less benefits and expenses divided by assets. So that's the net outflow without considering investment return. And being above, the higher you are, the better in this chart, as opposed to the lower. And you could see in the early 2000s, it was very high, but that's because the city was making those excess tobacco settlement payments and legal settlement payments. But since then, you've hovered somewhere, you're above the 50th percentile, which is good, and you're at right now at minus 2% of assets. And concern for negative cash flow, and that's something Steve might be able to elaborate on when he presents the board. It gets more of a concern when you start getting down to the minus 5% and worse. So I think you're in decent shape there. The next chart is your funded ratio on a market value basis. So we're not using any smoothing, and we've normalized all the plans in the public sector database to be at a 6.5% return. So the last time we had data on the other posted plans would be 2019, and there you see your black dot is in the upper half of the dark blue, so you're maybe in the 65th percentile, which is good, and that's even, that's with your 6.5 and everybody else at 6.5. So you are not in the middle of the pack, you're above the middle of the pack when it comes to the 188 largest plans in the country. So that's the national comparisons. Unless someone has any questions, Alice will take you through the California comparisons.
All right. So in terms of similar graphics, but for California specifically, so just to get a picture, this is comparing, there's 33 plans in this comparison, cities, counties, the state plans, and the UC plan. And of the systems here, these 33 plans for the public plans of California, a similar picture in that SDCERS has the lowest discount rate of the batch. And you see in the bottom graph that there are two plans at 6.5%. So that's SDCERS and San Mateo County. And I would like to clarify that this is from the 2019 valuation. This is a summary of 2019 because not all of the 2020s have been reported yet. So on the next slide, we see how SDCERS compares to its peers in California in terms of the inflation. And at the higher inflation, that has a more conservative element in the plan funding assumptions. And the bottom graph, the assumed real rate of return at the, so this is the discount rate less inflation, puts SDCERS at 3.45%. And here we are on the left end, the conservative end as well.
And you're the only plan there.
Yeah. And then finally on slide 33, we see how SDCERS stands in terms of funded ratio compared to the California peers. And SDCERS is right there in the middle. There are 13 plans, 13 of these 33 plans that are in that 70 to 79% funded ratio. And this also is normalized, so assuming a 6.5% discount rate for all those plans. And with that, Jean will start us off on a snapshot of the projections.
This is George Kinney, if I may. Since we're at the bottom of the pack on the 6.5% discount rate, if we went to the middle, which I think is what, 7%, how much of that unfunded liability would be reduced? Would we go to from 70 to 72%, or would it be from 3.3 billion down to 2 point whatever? Do you know offhand or not?
I believe it would go higher than 72, but I'm trying to see. Alice, I do have the projection model open. Do we have the discount rate in there?
I'm actually just pulling up, if we take a look at the economic assumption changes in the factors contributing to the UAL,
yeah,
to see if we can eyeball from there, but I don't have that an answer for George offhand.
Yeah, I'm sure Greg knows it or could find it, but it might be part of, certainly it's part of the story. We did this to ourselves because we're conservative. It's right. Not that, it's not totally from other factors that we couldn't control.
So when we complete our presentation, both Alice and I will double check and get the numbers to Greg and Marcel, and they can report it to you before this meeting ends today.
Thank you. Appreciate it.
If I can just make one comment on this, and that is that we use the term conservative or conservatism, and I want to be clear that in making the decisions that we made, at least at all the meetings that I was at, what we were doing is trying to make sure our policies matched reality. It wasn't that we were shooting to be conservative or liberal for that matter. It was literally trying to be as accurate as possible so that our plan sponsor and our stakeholders, including the members, understood what the real cost was to fund the plan properly. So I want to just caution my fellow board members in using terms like conservatism or liberalism or whatever the case is. I don't think that's ever been our goal. Our goal has been to be accurate. And I think it's important, based on how people pick up sound bites from us, that we think about the terminology that we use.
That's a good point. So we conclude with slide 35. Well, actually, we don't 36 and 37, but I'm going to talk about slide 35, showing the projections for the city. In the left-hand side, there's a column labeled ADC, and you can see if you earn the 6.5% each and every year, how the ADC will increase from 14.9, increase steadily until 2028, and then it drops down. That's when one of your amortization layers drops off. And then if you look at the bottom graph, you see a significant drop off in 2040. And you recall the board made an express decision that they did not want the UAL payment to ever be less than what it was back a few years ago, or $275.5 million. And that's why you see those level city payments between 2030 and 2039. The top graph is showing you the funded ratio gradually increasing up and getting to 100% by 2040. And as you know, if we were there live, we would be able to play with the what ifs. And Alice and I had looked at it, and if you have a good year, which you're having so far, it could have a significant impact on lowering costs. And I believe this is something, Alice, once the board approves it in March, we will have this tool online and give the board access to it. Alice, you can then talk about the port and airport projections.
Right. So when we look at the ports projections down at the bottom right graph, we see how the employer contribution does a little bit of a bump, and then that's just how the different bases, the UAL bases, when they drop off, you're getting the effects of that. And they also have that steady contribution with the UAL payment floor, and it's projected to reach full funding in approximately, 2044 there. And the airports, their projections on the next slide show a steady increase in the contribution as the unfunded slowly gets paid off, and the airport, with the new more and more participants continue to enter the plan, since it's still a relatively young plan, the liabilities continue to increase. So the contributions just have a steady pattern throughout the projection period shown, with a couple of increases and decreases based on the various layers, the UAL layers, as some of the gain bases fall off and some of the losses remain. You see different bumps up and down on those projected contributions. But again, based on the funding policy, the airport is projected to reach full funding before the end of the period shown here. So with that...
that concludes our presentation, other than Alice.
I'll just mention that in the appendix, we do have tables of all of the various tiers for the city, the port, and the airport of the member contribution rate. So what the current rate is that the members are paying, and the upcoming rate that will be effective July 1st, 2021.
That concludes our presentation. If anyone has any further questions, I'd be happy to answer them.
Any further questions, comments?
Yeah, Tom has a question.
Go ahead.
All right. So I noticed the member contribution rates will go up about 1.4% with this new valuation because they're substantially equal. So is there ever going to be a scenario if we have a better return, better experience study, better everything? Can we ever see those contribution rates go down, or is it only going to stay even or go up in the future?
Okay, first, the member contributions aren't affected by investment returns. Experience gains and losses go into the UAL. The city pays that. But assumption changes is what's been driving the member contributions up. So if we ever learn that we've gone too far with some assumptions, mortality or whatever, yes, they could go down.
Okay, thank you.
Any other questions, comments? Okay, well, thank you very much, Alice and Jean. That was an excellent presentation. As I mentioned earlier, we will be approving this matter at the March meeting, so this is just an informational first look. So we will see you in March. I do want to encourage all the board members to look at the actual reports that are attached to this presentation in your materials, particularly the board summary section is a really clear description, much like this, but if you need a refresher to really understand where the numbers come from. And I'm always a fan of table 5-2, which shows the amortization layer. Kind of interesting. Okay. Okay, so thank you very much. And with that, we will move on to the presentation of the 2020 CAFR and turn the floor to Marcel.
Good morning. Thank you. So with your materials is a copy of the CAFR for June 30, 2020. There also is the report from the outside auditors from MGO, the report on internal controls, and there also is the management letter, which is directed to the Audit Committee and to the board. So a couple things to highlight. One, this was done earlier than it ever has been done before. So thank you to the team that worked on this, which is, of course, Ted and his finance team, the investments team, benefits administration, member services, specifically the communications team. We appreciate all of your hard work in getting this done even earlier than it has been done in the past. The other very important thing to mention is in that management letter, there are no comments to management. So there is nothing in there, suggestions from MGO of things that we should change in the way that we are running our financial operations and in the presentation of our CAFR. So a very big thank you and congratulations to the team that worked on this for getting it done and getting it done very, very well. I'm happy to answer any questions you may have.
Questions, comments? Don't hear any, but I would echo your comments that the team did an excellent job, and we certainly appreciate everybody's efforts in getting this report done and for a great outcome and a quick outcome. So thank you. Thanks, Marcel. Let's see. With that, we're going to move to the Audit Committee. The Audit Committee met November 18th, and we have a new Audit Committee chair, which is Paul Kaufman, and want to thank Bobby for her work in that capacity in the past, and turn the floor over to Paul.
Thank you, Carol. I think the next thing on the agenda here then is the voting on the selection of our independent auditor. We obviously met on the 18th and interviewed our current auditors, MGO, as well as a company called Brown Armstrong, determined if the firms wanted to present to the board as the final independent financial auditor candidates. And as a result of those presentations, the Audit Committee unanimously voted 5-0 to have MGO continue as our current external auditor for the next 5 years. So I'd like to place that before the board for a vote. Carol, I don't think we need a second on this. Is that correct or not?
I believe that's correct.
Okay.
We don't. Okay, we are ready to vote. Ms. Broad?
Yes.
Ms. Coleman?
Yes.
Mr. Battaglia,
Yes.
Mr. Hawquist,
Aye.
Mr. Kenny,
Yes.
Mr. Machi,
Yes.
Mr. McBride,
Yes.
Mr. Provost,
Why not?
Ms. Boone,
Yes.
Mr. Shearson,
Yes.
Mr. Kaufman.
Yes.
All votes are in, and the motion passes 11-0.
Okay.
Okay. Carol, how do you want to handle the information items here? Can we vote on those?
We do not vote on them. They are for information only, and it's really your call if you want to just summarize each of those with a sentence, or we can just...
Let's just move on unless there are specific comments on these. I'd be glad to review a brief summary of these if people would like, but they're all in the packages. And there's nothing of noteworthy discussion from my perspective on this at this point.
Okay. If anybody wants to drill down, speak up, but otherwise we will move on. Okay. Thanks very much, Paul.
Thank you.
And next we have Disability Committee, our friend in the tropics, Charlie Hawquist. Is he still there?
Charlie, I believe you're on mute.
Okay, can you hear me now?
Yes.
Yes.
Okay,
Yeah.
good morning, aloha, from the guy who's stranded in Hawaii. First, I wanted to let everybody know to thank Tom Battaglia for joining the Disability Committee so that we will have our appropriate number of 5. So, Tom, thank you very much for becoming part of our committee. Yesterday's agenda had 3 action items, one of which was the application of Wayne Cross. We pulled that item for some further investigation. The other 2 items, one was a recommendation to approve the non-industrial disability retirement, and the other one was to approve or extend an adjudication deadline for a member. The committee discussed both items, and both were approved unanimously. If there's no questions or information needed on either of those 2 items, I move that we approve the Disability Committee agenda.
Okay, we are ready to vote. Ms. Broad,
Yes.
Ms. Coleman,
Yes.
Mr. Battaglia,
Yes.
Mr. Hawquist, Mr. Kenny,
Yes.
Mr. Machi,
Yes.
Mr. McBride,
Yes.
Mr.
Yes.
Provost,
Absolutely.
Ms. Boone,
Yes.
Mr. Shearson,
Yes.
Mr. Kaufman, Mr. Kaufman.
I was on mute. Sorry. Yes.
Okay. All votes are in, and the motion passes 11-0.
The only other thing that we discussed at yesterday's Disability Committee meeting, we did have a disability report, and I would like, again, to commend the staff on the fact that they're keeping all the applications timely and working through all the difficulties that COVID is creating for getting people their medical appointments and as well as their other appointments and meetings. But we're doing well. And again, thank you, staff, for doing an outstanding job. And with that, I conclude my report.
Thank you,
Unless
Charlie.
anybody has any questions.
Questions? No? Thank you. Best wishes on your travel plans. And I like your backdrop, and I realize it's real. It's not a photograph. Very nice. Okay. Next on the agenda is Business and Governments Committee, and that's Tanasi.
All right. We had 1 action item, and that was staff's recommendation to amend the General Counsel Charter, the board process for review of internal auditor, and the Audit Committee Charter. That action item passed unanimously, so if we can put that to a vote, that would be fantastic.
Okay, we are ready to vote. Ms. Broad,
Yes.
Ms. Coleman,
Yes.
Mr. Battaglia,
Yes.
Mr. Hallquist,
Aye.
Mr. Kenny,
Yes.
Mr. Machi,
Yes.
Mr. McBride,
Yes.
Mr. Provost,
Yes.
Ms. Spoon,
Yes.
Mr. Shearson,
Yes.
Mr. Kaufman.
Yes.
All votes are in, and the motion passes 11-0.
All right. We had one information item that was dealing with the board member elections. The current board terms for the 2 general member seats and the fire member seat will end on March 31st, 2021. And so as such, we're required to hold an election. The nomination process resulted in multiple candidates for the election that will begin on January 28th and end on February 11th. The 2 fire safety nominees who are eligible to run for the fire safety board member seat are Paul Lotz and Timothy Robles. The 4 city general member nominees who are eligible to run for the 2 general board member seats are Thomas Battaglia, Brett Bartolotta, Sarah Schoenman, and Tammy Williams. I'm sorry if I've massacred their names. Going into reports, we had a couple of issues. Member Services Division report. Staff executed a comprehensive outreach and action plan to accommodate the large number of appointees expected with the drop interest rate decrease. This preparation paid off handsomely, and the staff was able to handle the large volume of counseling appointments and taking care of all the members. Under the Benefits Administration report, Marcel was kind enough to let us know that in a fitting end to 2020, and not just a ploy by Ted to come in under budget, the December payroll failed. And so good news was they were able to get it taken care of, and everybody did get paid by the end of the year. I guess it's a hardware and software configuration problem that caused it is going to be rectified before the next payroll period. So that's a good news. Let's see. There was apparently retirement applications for December continued to come in after the Benefits Administration report was finalized. There was almost 200 applications. Medicare Part B reimbursement requests were up almost 50% compared to last December, which is basically 9 times the regular monthly average. SDCERS is working with plan sponsors to collect approximately $150,000 in contributions owed by active members, and I believe that Greg is going to strong-arm them, and I think we're hiring a bouncer as well, so this is going to be good. Other than that, there was no specific presentation on items 3 through 8, and as it turned out, the very learned committee who reads their stuff in advance, thank you, by the way, did not have any questions on those items. So if there are no other questions on any of the information or reports, I will turn this back over to Carol. Hearing none, Carol, the meeting is yours.
Okay, thanks so much. Good report. Next, we will turn to the Investment Committee, which met yesterday, and Karina Coleman, Chair, please take it away.
Sure thing. So we have 3 action items to review. The first of which was to approve a $30 million allocation to Waterton 14, and that's a closed-end value-add multifamily real estate fund. And I'm going to turn it over to Jamie Hamrick to walk us through that recommendation.
Great. Thank you, Karina. You have in front of you staff and consultants' recommendation for a $30 million commitment to the Waterton Residential Property Venture 14 for SDCERS non-core real estate allocation. The fiscal year 2021 real estate annual investment plan, which was approved at the September 2020 board meeting, called for $60 million to be invested this fiscal year in non-core real estate investments. This is the first allocation of that $60 million. After engaging in discussions and considering several alternatives, staff and Townsend have identified Waterton Residential Property Venture 14 as an opportunity that meets SDCERS real estate investment criteria and portfolio objectives. The addition of Waterton Fund 14 will provide the real estate portfolio with complementary diversification benefits and add exposure to the desired multifamily sector. In the U.S., there is an increased propensity to rent, There's consistently high and unaffordable home prices and low supply of housing in many markets. These demographic trends in the U.S. make multifamily an attractive sector right now. The Waterton Residential Property Venture 14 is a non-core closed-end real estate fund focusing on executing a value-add multifamily strategy across the U.S. The fund will target the acquisition of multifamily investments that are below replacement cost, mismanaged, have deferred maintenance, or require improvement. Waterton expects to focus on the top 30 markets in the U.S., which exhibit strong demographics, employment, and growth characteristics. The fund will target a net IRR of 12 to 13%. The committee voted yesterday to approve this investment 5-0. At this point, I'd be happy to take any questions that you have about this investment.
Amy, can you remind us again what the fee structure will be for this fund?
Absolutely. The fund will be charging 1.25% on committed investments during the investment period, which is for 3 years. And then after that, it'll be 1.5% on invested capital.
Thank you.
Sure.
As Jamie mentioned, this did pass unanimously yesterday. It seems to be a very compelling opportunity, particularly now. And I would like to make a move to approve. There's no further discussion for this opportunity.
Okay, we are ready to vote. Ms. Broad?
Yes.
Ms. Coleman?
Yes.
Mr. Battaglia?
Yes.
Mr. Hallquist?
Aye.
Mr. Kenny?
Yes.
Mr. Maggi?
Yes.
Mr. McBride?
Yes.
Mr. Provost?
Yes.
Ms. Spoon?
Yes.
Mr. Shearson?
Yes.
Mr. Kaufman?
Yes.
All votes are in, and the motion passes 11-0.
Thank you. The next item we have on the agenda today is to approve to maintain a 16% weighting to S&P 500. I believe I'll be turning it over to Steve Boss to walk the committee through this item.
That will be Anders.
Oh, Anders.
Karina, I'll take it today.
Very good.
Thanks, Karina. Good morning, everyone, and Happy New Year's to you. As you know, the board approved the portfolio structure recommendation at the July 2020 board meeting. This structure included a 16% allocation to an S&P 500-based mandate within the U.S. equity asset class. This allocation previously held the structured alpha investment up until that manager was terminated earlier this year. As a part of the recommendation to terminate that manager was to temporarily allocate the S&P 500 mandate to SDCERS' current S&P 500 index fund managed by BlackRock, while staff and the consultant analyzed available options to fill that mandate. Now, these options were carefully weighed against SDCERS' core investment beliefs and the ultimate goal of maintaining a bias-free portfolio structure. Many of the options that we considered would ultimately have created a slight bias to small cap stocks. So the main consideration really was therefore to whether to implement an active manager or maintain the allocation in the current passively managed index fund. So we had many in-depth discussions with several active managers that we had very favorable opinions of, and their investment process and track record, while they were impressive, we recognized that it's very difficult for managers in the U.S. large cap space to generate sustainable excess returns. And in fact, as Steve and Katie mentioned yesterday, the majority of active managers in that space are not able to deliver long-term excess returns due to the high efficiency of that market. Therefore, we want to avoid paying high fees to active managers for market-like returns. And because of this, investment staff and Aon believe it's best to use active management in other areas of the portfolio where the market is less efficient and maintain the passive management approach for this mandate. So since the funds are already temporarily invested in the S&P 500 index fund, the recommendation is therefore for the board to approve staff and Aon's recommendation to maintain the 16% weighting to the S&P 500 index fund within SDCERS' U.S. equity portfolio. And with that, I will be happy to answer any questions if there are any.
Anders, I don't really have a question, just a common agreement that it's very difficult for the median manager after fees to add value in this space. And I'm completely in agreement to maintain the passive allocation at 1.5 basis points with BlackRock. I do not think we can do much better, looking long term on behalf of the plan for this particular allocation. Are there any other questions on this item? If not, I'm going to go ahead and make a move to approve that we maintain the 16% weighting to the S&P 500 within the U.S. equity portfolio.
We are ready to vote. Ms. Broad?
Yes.
Ms. Coleman?
Yes.
Mr. Battaglia?
Yes.
Mr. Hallquist?
Aye.
Mr. Kenny?
Yes.
Mr. Maggi?
Yes.
Mr. McBride?
Yes.
Mr. Provost?
Yes.
Ms. Boone?
Yes.
Mr. Shearson?
Yes.
Mr. Kaufman?
Yes.
All votes are in, and motion passes 11-0.
Thank you,
Okay,
everyone.
great. Thank you. The last item, action item that we have is to approve some changes to our proxy voting policy and guidelines. And for this item, I will hand it over to Demetrius Haldis.
Thank you, Karina. SDCERS reviews and updates its proxy voting guidelines on an annual basis. The way that the process works is that SDCERS' proxy voting vendor, Glass Lewis, releases guidelines at the start of each year that highlight proxy issues of note and the firm's stance on each of these. SDCERS then uses those guidelines as a framework for modifying its own guidelines. So this year there were 3 recommended changes. The first is voting against a governance committee chair when detailed records of proxy voting results from the prior annual meeting have not been disclosed. The second is voting against the nominating chair of a board with fewer than 2 female directors, or fewer than 1 if the board is 6 people or less. And the third is voting against the governance chair of a company in the S&P 500 index who fails to provide disclosure of that board's role in overseeing environmental and social issues. So the red line and clean version of SDCERS' proxy voting guidelines are attached to the materials, so you can see how these changes were incorporated into our guidelines. And this item passed yesterday at the investment committee meeting unanimously. Are there any questions?
Okay. I don't hear any, Demetrius, and I don't have any myself. I think this is really a best practice item, so I'm going to go ahead and make a move to approve the recommended changes to the proxy voting policy and guidelines.
We are ready to vote. Ms. Broad?
Yes.
Ms. Coleman?
Yes.
Mr. Battaglia?
Yes.
Mr. Hallquist?
Aye.
Mr. Kenny?
Yes.
Mr. Maggi?
Yes.
Mr. McBride?
Yes.
Mr. Provost?
Yes.
Ms. Boone?
Yes.
Mr. Shearson?
Yes.
Mr. Kaufman?
Yes.
All votes are in, and the motion passes 11-0.
And the information item we have today is to review the total performance report. I will hand it over to Anders Norman to walk us through results for September 30th.
Thanks, Karina. Jessica, if you can pull up the total fund performance report and turn to slide 9, please. Thank you. So as you can see here, the total fund generated a return of 4.4% for the quarter, driven by strong performance across public markets and private equity. However, this return fell slightly short of the benchmark's 4.8% return for a few reasons. Main driver of the underperformance came from the Opportunity Fund. As you may remember, the role of the Opportunity Fund is to provide diversification to the total fund. And as such, the Opportunity Fund will really not keep up in strong bull market environments like the one we're in right now. But on the flip side, it should outperform when the stock market experiences turmoil like it did in the first quarter of this year. And the Opportunity Fund actually outperformed its benchmark by 9% during the first quarter when the market was in turmoil. So I just wanted to make that clarification. Moving on to, I thought I would touch a little bit on the 1 year too, since it does not look as good on a relative basis against the benchmark. The underperformance there was 4%, and it was driven by underperformance in the U.S. equity class attributed to the structured alpha investments from early this year, as well as underperformance in the Opportunity Fund for the same reasons as I mentioned earlier. The good news here is that the longer time periods show solid returns exceeding the actuarial rate of return for the system. And we continue to see strong absolute performance for the fourth quarter of this year. And I can give you an estimate based on internal calculations. As of December 31st, the total fund is up 13.8% for the fiscal year to date, as of July 1st, that is. And let's see here. This is attributed to many of the value-oriented public market managers that have lagged. They're showing nice excess returns for the fourth quarter. For example, Brandes that have lagged over the last couple of years returned 20% in the fourth quarter, beating its benchmark by 4%. And Dodge & Cox in the global equity asset class returned 22.5% for the last 3 months, beating its benchmark by 8%. If we move to slide 16, please, Jessica. So, looking at the asset classes here, we can see solid outperformance. We can see solid outperformance across most public market asset classes, except for global equity, where the underperformance was driven by Dodge & Cox and GMO due to their value-oriented style of investment. As I mentioned earlier, Dodge & Cox had a nice comeback in the fourth quarter, so we're hoping to see nice outperformance there for global equity for the fourth quarter. Emerging market debt also saw strong performance relative to its benchmark, with all three managers beating their benchmarks, driven by allocations to US dollar-denominated debts, mainly in South America and Africa. Infrastructure underperformed its benchmark for the quarter. That was as a result of energy-related investments due to the drop in energy prices. But as you know, performance calculations in especially private market asset classes such as infrastructures are typically done using IRRs, and since inception, since we're looking at very long time periods for those to materialize, and not time-weighted rate of returns as we're calculating here. So performance can therefore fluctuate greatly from quarter to quarter when we're using time-weighted rate of returns for private market asset classes. So with that, I am done, and I'm happy to answer any questions if there are any.
Okay, thank you very much, Anders. Good report. Did I hear a question there from, is it George? Sorry, I thought I heard somebody chime in there.
No, not me.
Okay, very good.
This time.
All right, well, thank you. Anders, I don't have any other questions. It's obviously a good longer-term performance, relatively speaking, a little bit weaker on the, certainly on the 1 year number, but that should improve as we move further away from the whole coronavirus sell-off and the loss on the structured alpha product. With that, Carol, I think I will turn it back over to you.
Okay, thanks very much. Appreciate it. So we're nearing the end of our regular agenda. We're going to have a closed session in a few minutes, but let me just ask if there are any questions or comments from board members at this time before we wrap up. Hearing none, would like to hear any questions or comments from staff, and I think maybe Greg has something he'd like to say.
Yes, well, thank you. I just love this part of our agenda. I would like to wish the board, staff, and our members a very happy new year. And as we start the new year, I thought it would be nice to actually try to remember a few of the good things that happened during 2020 at SDCERS. We made health and safety a priority here at SDCERS. An example is implementing our extensive teleworking staffing plan. We worked well as a team to solve numerous new problems, such as creating remote access with limited means and developing electronic document signing. We shed old work preferences and learned to do critical tasks differently, such as starting one-on-one counseling on the phone and webinar group counseling. We continue to build our solid governance structure and compliance structure in difficult times by adopting a compliance program charter and created an ad hoc board committee to improve our executive evaluation process. We strengthened our relationships with our stakeholder groups by presenting on REA Zoom meetings as they started their Zoom meetings, and worked with our plan sponsors' budget teams with regards to ADC payments. We stayed focused on delivering our mission using our core values. By example, we paid each and every retiree payroll accurately and timely during the pandemic, and as talked before about facing challenges doing so. And so as they say, every challenge is an opportunity for growth. I'd also like to do a board election update, a little bit more from what Tanasi had shared with us. Just wanted to let you know that following our January 28th through February 11th voting period, we will have the election results, and we'll have a good amount of time to begin orienting some new board members prior to our May 2021 meeting. The new year also means tax reporting for last year. Our annual tax reporting project is on track to mail our federal 1099 forms and post a copy on the SDCERS member portal prior to the IRS deadline of January 31st, 2021. I'd like to give a special note of appreciation to Ted LaSalvia, our controller, for being this project lead, and a good number of staff from various SDCERS divisions who will be completing this time-sensitive project in a very, very short time window. I would also like to recognize and thank our information systems, finance, and benefit administration teams. As previously mentioned, on Christmas Eve evening, my phone rang and it was Marcel. And I figured if Marcel was calling me on Christmas Eve, it was probably important. And it was. That afternoon, we ran the December monthly retiree payroll program, and the information system decided to stop halfway through its routine. And at that point, our retirees and beneficiaries were not getting paid in December. One of our IT managers, Michelle Wegner-Malecki, who was supposed to be on vacation that day making cookies with her kids and enjoying a traditional family bike ride, worked Christmas Eve with one of our IT consultants, Raghu, to begin fixing the problem. And over the weekend, they were joined by many more SDCERS staff from various divisions. And by Sunday morning, we had successfully completed our December 31st retiree payroll program. Our retirees and beneficiaries were paid accurately and on time. A root cause analysis found a recent vendor upgrade and is creating an intermittent communication problem disruption in our IT environment. It was very unfortunate that it happened in the middle of creating our December retiree payroll, and we are actively taking steps to remedy that problem. And finally, I'd like to recognize and thank our member services and benefits administration teams. At our last meeting, we identified a possible surge in member applications for drop exit due to the drop annuitization rate decreasing from about 3% to 2% as of January 1st. And that drop exit surge did happen, as noted by Tanasi. Our average drop exit request increased from 34 per month to 123 applications received. Additionally, if we looked at all the types of applications received, drop exit, drop entry, and service retirements, the average monthly request increased from about 78 to 198. We were able to accommodate our members' requests with increased number of member service counseling sessions during December with support from our benefits administration team. And our next challenge, which will be our benefits administration is already working on, is processing all of those member applications for new monthly retirement benefits to their members or to their drop account. And with that concludes my comments. And again, Happy New Year.
Wow. Well, thank you so much for that summary. I just want to echo, and I'm sure all the board would share this sentiment as well, that the staff led by Greg has done an excellent job in a very difficult time, keeping everything running very smoothly. And we're so appreciative of that. And extra thanks to Michelle and those who worked during the holidays on getting the retiree payroll straightened out. That's super important. And so thanks very much. Appreciate it. Okay, excuse me. With that, the regular meeting is adjourned. And I don't think I actually need to adjourn it. I just need to go to closed session at this point.
Correct.
So we're not adjourned. We're in closed session. And so if you're not included in closed session, please terminate your Zoom session. It's going to take a few minutes for Cynthia to get this all organized, and I'd like to suggest we take a 5-minute personal break for those of us who are staying in the closed session. Okay? Thank you.
Thank you.
There he is.
Hey.
Cynthia
All right.
there?
They're on their way downstairs. There's Cynthia.
Hello.
Okay. Cynthia, are we now in open session?
Not yet. We got just a minute.
Okay. Let me know.
Okay. I'm not trying to unmute me here.
Well, Carol, while we're waiting, I just wanted to say thank you so much for your flexibility with the changes of the agenda and doing stuff. So you're awesome.
No worries. No worries. That's what I'm here for.
Best president ever.
Oh, you're so nice. Yeah, it was a struggle this morning between getting your text message and trying to put on mascara, which, is something we don't do anymore.
Ready? Okay. We're ready, Carol.
Okay, thank you. So we have now resumed open session, and I'd like to ask Johnny Tran for a report from the closed session.
Yes, Carol, there's nothing to report out of closed session today.
Okay, thanks very much, Johnny. And with that, I'd like to thank everybody who participated and all the great work that was done for this meeting. And the meeting is adjourned.
Okay. And adjourned.
Thank you.
Good to see you. Bye-bye.
Bye.
Bye. Thank you.
Have a good one.
Goodbye.